Ladies and gentlemen, today we are witnessing a development in the global markets that demands our immediate attention. China, one of the largest players in the silver market, has announced a halt to silver trading. This is not a minor event. It is a seismic shock with potential reverberations across financial markets worldwide. The first thing to understand is that silver is not just a commodity. It is a reflection of industrial demand, investor sentiment, and broader monetary conditions. China's decision to pause trading indicates underlying stresses in either the market infrastructure, liquidity, or broader economic pressures. Whenever a major market participant takes such drastic action, it is a signal that something is fundamentally shifting. And as investors, we must pay attention. The halt of silver trading in China is not just a routine market adjustment. It is a signal that carries significant weight for anyone involved in global financial markets. China is one of the largest consumers and traders of silver in the world, and its actions ripple far beyond its borders. When a market of this magnitude takes the unusual step of suspending trading, it is often because there are pressures building underneath the surface. Pressures that may not be immediately visible to casual observers, but that experienced investors recognize as red flags. These pressures could relate to liquidity shortages, volatility concerns, or broader economic stress within the country. Whatever the immediate cause, the effect is clear. Markets are being forced to pause, reflect, and adjust to new conditions, and that pause itself is an indicator of systemic stress. Historically, when major markets halt trading, it often precedes periods of heightened volatility. The reason is straightforward. Markets function on the balance of supply and demand, and when trading is interrupted, that balance is temporarily suspended. Investors cannot execute their strategies, arbitrage opportunities are frozen, and pricing signals become less reliable. Once trading resumes, all the pent-up activity can flood the market at once, creating sharp price movements that are sometimes disconnected from underlying fundamentals. For silver, a commodity that is already sensitive to industrial demand, currency fluctuations, and investor speculation, this can translate into dramatic short-term swings. The potential for overshooting, where prices move much further than they logically should in the short term, is high, which can create both risk and opportunity for those who are paying attention. It is also important to understand that silver is deeply intertwined with economic and monetary dynamics, especially in countries like China that have large manufacturing and export sectors. Industrial demand for silver is significant because it is used in electronics, solar panels, and a range of industrial applications. A halt in trading may reflect or even exacerbate disruptions in these sectors. Investors looking purely at price charts might see a sudden drop or spike, but the underlying reality often involves shifts in production, supply chains, and investor confidence. This makes understanding the broader context critical. Without that understanding, traders might overreact to short-term price movements without recognizing the structural reasons behind them. Moreover, the psychological effect of halting a major market should not be underestimated. Investors worldwide look at China as a bellwether for trends in commodities and industrial metals. When such a decisive move is made, it tends to create anxiety and uncertainty in markets far beyond China's borders. People begin questioning liquidity, pricing mechanisms, and even regulatory stability, all of which can feed into self-reinforcing cycles of volatility. Those who understand market history recognize that moments like these are not just technical disruptions. They are signals that the system is experiencing stress that requires careful observation, analysis, and strategic adjustment. Finally, this event serves as a reminder of the interconnectedness of global markets. What happens in Shanghai or Beijing no longer stays confined to Asia. It flows quickly to London, New York, and other major financial centers. For investors and portfolio managers, This means that a halt in Chinese silver trading is not merely a local concern. It is a global one. It is an opportunity to reassess exposures, think about liquidity, and consider the broader implications for both risk and opportunity. In complex systems like global financial markets, disruptions are inevitable, but those who recognize and interpret these signals correctly are often positioned to navigate uncertainty more successfully than those who react impulsively. In short, the halt of silver trading in China is a powerful reminder that markets are sensitive, interconnected, and often fragile. Understanding why such a halt occurs, anticipating its effects, and preparing strategically are essential steps for anyone seeking to operate effectively in today's global financial environment. Silver is often thought of as just another commodity, but to understand its role in the market, you have to see it as far more than that. It serves multiple functions simultaneously. It is an industrial metal, a monetary hedge, and a barometer of investor sentiment. Unlike some commodities that are largely used for consumption, silver occupies a unique space where both practical and psychological factors drive its value. Industrial demand comes from sectors like electronics, solar energy, medical devices, and even advanced technologies that require its conductive and reflective properties. At the same time, silver is widely held by investors as a hedge against inflation, currency fluctuations, or broader economic uncertainty. Because of this dual role, any disruption in its trading or a sudden move in its price resonates across different types of market participants, each reacting based on different incentives and motivations. One of the most critical aspects to understand is that silver is highly sensitive to liquidity conditions. While gold is often thought of as the ultimate safe haven, silver's smaller market size and lower overall liquidity make it more prone to sudden price swings. In practical terms, this means that even relatively modest imbalances in buying or selling pressure can produce significant short-term movements. When trading is halted, as it has been in China, that sensitivity is amplified because investors cannot act to balance supply and demand. This creates a temporary vacuum in which prices no longer reflect the normal flow of information and economic activity. Once trading resumes, the imbalances can explode into volatility, sometimes exceeding what one would expect based solely on fundamentals. Understanding silver in this context requires seeing it as a complex system influenced by both real-world industrial factors and market psychology. Investor sentiment is another powerful driver of silver prices. In times of uncertainty, silver is often sought as a safe haven. But it is not just about storing value, it is also about perception. If investors believe that volatility is coming, or if they see signs of market disruption such as a trading halt, their actions are often preemptive. They may buy in anticipation of higher prices or sell to mitigate perceived risk. These behaviors can become self-reinforcing. In other words, silver prices are not only a reflection of supply and demand, they are also a reflection of collective expectations, fears, and confidence levels in the market. This is why understanding silver requires more than looking at charts. It requires a holistic view of market psychology, investor behavior, and economic conditions. Moreover, silver interacts with global monetary conditions. As a precious metal, it is often influenced by interest rates, currency movements, and central bank policies. When fiat currencies weaken, or when there is concern about inflation, silver tends to attract attention because it retains intrinsic value. Conversely, when interest rates rise and currencies strengthen, silver may experience selling pressure. These macroeconomic dynamics are intertwined with industrial and investor-driven demand, making silver a highly complex and interconnected asset. For anyone navigating the markets today, ignoring these Annexions is a mistake. It is not enough to look at silver as a commodity in isolation. You must understand it as a node in a much larger financial and economic network. Finally, the lesson is that silver is a barometer of broader systemic conditions. Its movements often signal stress, opportunity, or transition within markets. When trading halts occur, or when volatility spikes, it is rarely about silver alone. It is about the underlying forces that affect multiple sectors, economies, and investor behavior simultaneously. Recognizing this allows investors to interpret silver not just as a commodity to trade, but as a lens through which to understand global market dynamics. Approaching silver with this perspective encourages disciplined thinking, strategic positioning, and a recognition that every price move has context that goes beyond the immediate numbers. When a major market like China halts silver trading, one of the immediate and most consequential effects is the potential for a sharp increase in volatility. Volatility is not just a technical term for price swings. It reflects uncertainty, risk, and the limits of liquidity in a market. In normal circumstances, buyers and sellers interact continuously, allowing prices to adjust gradually to supply and demand. However, when trading is suspended, that continuous interaction is interrupted, and the natural mechanisms that stabilize prices are temporarily disabled. This creates an environment where, once trading resumes, prices can swing dramatically, sometimes overshooting what fundamentals would suggest. For investors and portfolio managers, this is a critical moment that requires careful analysis and strategic thinking. The underlying reason for these swings is straightforward. Markets are systems of information. Prices convey information about scarcity, demand, sentiment, and expectation. When a major participant like China pauses trading, the flow of information is interrupted. Market participants around the world are left uncertain about the true balance between supply and demand, and that uncertainty fuels speculation, which can magnify price movements. In essence, the market is forced to catch up once trading resumes, and that catching up often comes in the form of extreme price swings. For silver, which is both an industrial metal and a financial asset, these swings can be particularly pronounced because it is simultaneously influenced by production needs, investor psychology, and macroeconomic factors. Another important consideration is liquidity risk. Silver, while widely traded, is still smaller and less liquid than gold. This means that sudden surges in buying or selling pressure can move prices more dramatically than in a highly liquid market. When trading halts occur, investors cannot adjust their positions in real time, creating pent-up demand or supply. Once the halt ends, these orders flood the market at once, often producing exaggerated price movements. This is why volatility following a halt is not random. It is a function of market mechanics, investor behavior, and the concentration of positions that have accumulated during the pause. Understanding this dynamic allows investors to anticipate potential outcomes and respond strategically rather than reactively. Volatility also has psychological effects. Human behavior plays a central role in financial markets. When investors see sharp moves, fear and greed are triggered almost instinctively. Fear can lead to rapid selling, while greed can drive overbuying in anticipation of further gains. In the context of a halted market, these reactions can compound once trading resumes, creating a feedback loop that magnifies price swings even further. Recognizing these psychological patterns is critical for anyone navigating turbulent markets. Those who understand that volatility is a natural response to uncertainty are better positioned to act with discipline rather than emotion. It is also worth noting that increased volatility can present both risks and opportunities. For traders who are unprepared, It can result in losses if positions are not carefully managed. However, for those who have planned for uncertainty, it offers the chance to capitalize on dislocations in price. Volatility creates mispricings, and mispricings are the foundation of opportunity in markets. The key is preparation, having a clear understanding of exposure, liquidity, and risk tolerance before the shock occurs. Once volatility erupts, there is little time to make thoughtful decisions, so proactive planning is essential. Finally, the broader lesson is that volatility is an inherent feature of complex financial systems. It is not something to be feared, but something to be understood and managed. In the case of China halting silver trading, the likely surge in volatility is a signal, a reflection of systemic uncertainty and the limits of liquidity. By studying these patterns, understanding the forces at play, and preparing accordingly, investors can navigate turbulence more effectively. Market shocks are inevitable, but those who recognize and anticipate volatility are the ones who can both protect their capital and seize the opportunities that such disruptions create. In times of market turbulence, such as a sudden halt in silver trading in China, the importance of risk management and diversification cannot be overstated. Too often, investors focus exclusively on potential gains and overlook the complex interplay of risks that can compound during periods of disruption. Silver is not just influenced by supply and demand. It is subject to liquidity constraints, investor psychology, macroeconomic forces, and geopolitical events. Understanding these multiple dimensions of risk is essential for maintaining stability in portfolios and avoiding catastrophic losses. Diversification, both across asset classes and within markets, provides a buffer against these shocks. It allows investors to navigate volatility without being overly exposed to any single source of risk. This is not theoretical advice. It is a principle grounded in the observation of market behavior over decades, from commodities crises to currency disruptions. One critical aspect of risk management is understanding liquidity risk. When a major market like China suspends trading, it prevents investors from acting on their positions, creating a temporary but real liquidity gap. Liquidity is what allows investors to convert assets into cash without materially affecting the price. Without it, even well-conceived strategies can go awry. For silver, this is particularly relevant because its market is smaller and more reactive than that of gold. Large trades in a thin market can dramatically move prices, and when liquidity is constrained, the consequences are magnified. Investors who fail to account for this risk may find themselves in positions that are impossible to unwind without substantial losses. Proper risk management anticipates such scenarios, ensuring that exposure is balanced and that contingency plans are in place. Diversification is another essential tool. In practice, this means not putting all your capital into a single asset or market, regardless of how promising it may appear. While silver offers opportunities as both a commodity and a financial hedge, concentrating too heavily in one asset increases vulnerability to market shocks. By spreading investments across multiple asset classes, stocks, bonds, precious metals, currencies, and alternative investments, investors can reduce the overall impact of any single disruptive event. Within the silver market itself, diversification can mean balancing positions across physical holdings, futures contracts, ETFs, and different geographic markets. Each layer of diversification adds a degree of resilience, allowing investors to weather volatility without panic. Equally important is maintaining discipline in decision-making. Emotional reactions to market shocks are one of the most common sources of losses. When trading resumes after a halt, prices can move sharply in either direction, and it is natural for fear or greed to influence behavior. A disciplined approach, when informed by risk management, scenario planning, and a clear understanding of exposure, helps prevent rash decisions. This discipline is rooted in the recognition that markets are inherently uncertain and that no one can predict every movement. By focusing on what can be controlled, position sizing, liquidity planning, and diversification, investors can maintain a level of stability even in turbulent conditions. Finally, proper risk management is not just about protecting capital, it is about creating optionality. When portfolios are structured to handle shocks, investors are positioned to take advantage of opportunities that arise precisely because others are overexposed or panicking. Market disruptions, while stressful, create mispricings and opportunities for those who are prepared. By combining diversification, liquidity awareness, and disciplined decision-making, investors can turn uncertainty into a strategic advantage. In conclusion, risk management and diversification are not optional, they are essential components of successful investing. In a situation like China's silver trading halt, they serve as both a shield and a foundation for opportunity. Markets are complex, interconnected systems, and shocks will always occur. Those who prepare thoughtfully, maintain balance, and act with discipline are not only more likely to survive volatility, they are more likely to thrive in the aftermath. The halt of silver trading in China is not an isolated event. It has far-reaching implications that extend well beyond the borders of a single country. Global markets are deeply interconnected, and actions taken in one part of the world ripple through supply chains, industrial production, and investor sentiment across continents. When China, one of the largest consumers and producers of silver, suspends trading, it sends a strong signal to international markets that conditions are unusual and potentially precarious. This is not merely a domestic regulato ride decision. It is a global economic event that affects prices, portfolios, and strategies worldwide. Investors and market participants must recognize that their exposure to silver, even if geographically distant, is directly influenced by what occurs in China. One of the most significant macroeconomic implications involves supply chains and industrial production. Silver is not only a financial asset, but also a critical component in numerous industrial applications, from electronics to solar panels to medical equipment. Disruptions in the Chinese silver market can affect the availability and pricing of raw materials, which in turn can influence manufacturing processes and costs globally. Companies that rely on silver for production may experience delays or increased expenses, which can ripple into broader economic activity and even affect corporate earnings in seemingly unrelated sectors. Understanding these linkages is critical for investors, as it underscores that market shocks are rarely confined to the specific commodity in question. They cascade through the broader economic system. Investor confidence is another area that is deeply affected by such events. China's markets are closely watched as bellwethers for trends in commodities and financial markets. When trading is halted, it creates uncertainty about liquidity, regulatory stability, and price transparency. This uncertainty can spread quickly, influencing sentiment in international markets and prompting risk aversion among investors. Portfolio managers may adjust their positions not because the fundamentals of silver have changed dramatically, but because the perception of risk has increased. In global markets, perception often drives behavior as much as reality, and understanding this distinction is essential for making informed decisions. The interconnectedness of global financial systems also means that price signals from one market influence others. When a shock occurs in China, it is immediately reflected in futures markets, ETFs, and other derivative instruments worldwide. Investors who are unaware of these linkages may be caught off guard by sudden price movements or unexpected correlations. Conversely, those who understand the systemic nature of global markets can anticipate the ripple effects, adjusting exposure and hedging risk accordingly. In an era of high-speed information and algorithm-driven trading, these connections are more immediate and impactful than ever before, making situational awareness a critical skill for market participants. Moreover, this event serves as a reminder that policy decisions in one nation can have macroeconomic consequences worldwide, whether driven by liquidity concerns, regulatory caution, or broader economic strategies. China's trading halt reflects the authority of governments to influence markets directly. This highlights the need for investors to consider geopolitical and policy factors as integral components of their risk assessments. Global portfolios cannot be insulated from national actions, and an effective investment strategy must incorporate these potential disruptions into planning and decision-making. Ultimately, the lesson is clear. No market exists in isolation. The halt of silver trading in China demonstrates how an event in one country can cascade through industrial, financial, and psychological channels, affecting markets across the globe. Recognizing this interconnectedness allows investors to move from reactive behavior to proactive strategy, positioning themselves to manage risk and seize opportunity in a complex, dynamic environment. Understanding the global implications of local events is not optional. It is essential for navigating modern financial markets successfully. Market shocks, such as China's halt of silver trading, are inevitable features of the global financial system. No investor, no matter how experienced, can predict every move or control every outcome. What distinguishes successful investors and portfolio managers is not their ability to foresee every disruption, but their preparation and adaptability when uncertainty strikes. Understanding that shocks are a natural part of complex systems allows one to approach volatility not as a crisis to panic over, but as an opportunity to make disciplined, strategic decisions. This mindset is critical because markets are dynamic, interconnected systems in which disruptions, whether due to policy, liquidity, or investor sentiment, create both risks and opportunities simultaneously. Preparation begins with understanding your exposure. In a world where events like China's trading halt can influence prices globally, it is essential to know where your positions lie and how they might be affected. This involves more than simply noting what you hold. It requires analyzing the potential impact of market interruptions, liquidity constraints, and psychological reactions across markets. Those who carefully map out the relationships between assets and global economic variables can anticipate the potential effects of shocks more accurately. By contrast, investors who neglect these relationships are often caught off guard, reacting emotionally and incurring unnecessary losses. Preparation transforms uncertainty from a source of fear into a foundation for informed decision-making. Adaptability is the next critical component. In complex markets, conditions can change suddenly, and the ability to adjust strategies in response to new information is vital. A rigid approach, no matter how well designed under normal circumstances, can become a liability during disruptions. For silver, a halt in Chinese trading alters liquidity, pricing signals, and investor psychology almost instantaneously. Those who can adjust position sizes, diversify holdings, or implement hedges quickly are more likely to navigate turbulence successfully. Adaptability does not mean acting impulsively. It means having frameworks in place to respond thoughtfully to changing circumstances while maintaining discipline and focus on long-term objectives. Recognizing opportunities within shocks is equally important. Market disruptions, while stressful, often create mispricings, situations in which price temporarily deviate from underlying fundamentals. These deviations present opportunities for disciplined investors to enter or exit positions strategically, For example, a sudden spike in silver volatility may scare some participants into selling, creating a temporary undervaluation that prepared investors can exploit. Conversely, overenthusiastic buying following a halt can present an opportunity to scale back exposure or hedge risk. The key is to separate emotional reactions from rational analysis, using the shock as a tool to identify where value lies and how to act within a calculated risk framework. Another vital aspect is learning from every disruption. Each market shock, whether expected or sudden, offers lessons about system dynamics, investor behavior, and macroeconomic relationships. By studying the effects of events like China's trading halt, investors refine their models, improve risk management protocols, and develop greater resilience for future shocks. This cumulative learning is what enables investors to not just survive volatility, but to thrive over time. It transforms every crisis into a source of insight and competitive advantage. Finally, the broader principle is that in complex financial systems, uncertainty is not an anomaly, it is the norm. Accepting this reality allows investors to approach markets with humility, discipline, and foresight. Market shocks are inevitable, but panic is optional. Those who prepare strategically remain adaptable and understand the systemic dynamics at play are positioned to manage risk effectively and seize opportunity when others are overwhelmed by fear. The halt of silver trading in China is a clear example of how shocks test the resilience of investors and the robustness of their strategies. By embracing the lessons embedded in volatility, investors can navigate uncertainty with confidence, transforming potential crises into moments of strategic advantage.